So that's a dovish read as far as currency markets go. Let's go straight to Charlie Jamieson. He's joining us from Jamieson Coote Bonds. Charlie, welcome back to the program. You're quoted as saying that the Reserve Bank is in a parallel universe. That, of course, was prior to today. So what do you make of the commentary coming from the Reserve Bank governor now?
Good morning. I had quoted that the Reserve Bank have been a tremendously reactionary central bank, and now they are reacting again. But this is looking a little bit more proactive, which is good. There's clearly, from the comments today, it's fairly obvious to us that the Reserve Bank are going to provide more stimulus. That's probably in the first iteration likely to be a small interest rate cut, as the markets are expecting in November. And behind that additional bond buying, Governor Lowe did note that our 10-year bonds are a lot cheaper in yield than many other global competitors. That's something that we've noted over the course of this year. Australia remains cheap and in a very steep yield curve structure. And that's now noted, I guess, with these huge fiscal loads that require funding. The RBA can certainly help out here in stimulating things by getting those yields lower, by mechanically operating in that part of the curve. And probably we would expect also helping the state governments, known as semi-government issuers in our world, also lowering their cost of borrowings in time, because there is going to be the need for substantial fiscal support from both state and federal governments for quite some time yet.
Charlie, pretty much the entire tenure of Governor Lowe's at the RBA, the bank has been banging on about financial stability risks, and a lot of the time it appears that has gone and trumped any other measures when it comes to trying to achieve policy mandates such as employment and inflation. What did you make of the governor's tweak today to that view? So rather than in the past talk about all the negatives that could have come about by further easing the like, today he talked about the positives of private sector balance sheet repair, increased hiring in the private sector. Is that basically a green light to say, look, we're not going to go and hold back anymore, we're going to go?
Yeah, look, I think it is. I mean, they've been right to note that those financial stability risks are ever present. I guess one of the problems globally that we have when central banks have embarked on this pathway out of the GFC is that it really is a down the rabbit hole moment. And if you don't follow, en masse, invariably you suffer, a lack of competitiveness via a very strong currency. And so this is really a problem not of the RBA's making. And I have no question that they've not wanted to embark on a lot of the programs that they've embarked upon, like cutting rates down to these levels, which a few years ago, were discussed as being something that we could never foresee, like QE programs that are now fully operational. And I guess the big swing factor in the future is negative interest rates. We're told that it's very unlikely to occur here, but we're watching around the world as it is likely to occur in England, in New Zealand, in Canada. And clearly Australia is a very similar type of economy to those other Western economies. So I do think it is a bit of a green light. Clearly, they do want to make sure that there is stabilisation in particularly things like the housing market. It's in no one's interest to watch that all collapse, and nor that it is collapsing, but mind you, but it certainly does require a different type of stimulus now versus, pre-COVID type world where clearly there would have been more, concern about that financial stability. Now I think, it's really all guns blazing to make sure we can do everything we can to try and lift the economy and make sure it doesn't suffer unnecessary destruction.
Yesterday, at the same event, we heard from the RBNZ's assistant governor, and he was saying, we're not playing chicken when it comes to this whole possible interest rate or negative interest rate scenario. Do you think that, although we have less sort of endorsement of those really unconventional monetary policy tools being used here in Australia, do you think that will then, if we do have some further easing and we do have, bolstering of the bond buying program, potentially the TFF as well, that will naturally be the next conversation here in Australia?
Look, I think it probably will be, sadly. No one enjoys negative interest rates, but as we've found out around the world, and they're not overly effective, but when you do need to find, something else in the toolkit to try and provide that little bit of extra stimulus, it's one of the only levers left, and it really does target currencies. Absolutely. So it's really, more a hinge to the fact whether if everybody else uses it, then we're caught in a competitive disadvantage if we don't use it. And so as much as there is natural resistance, as there should be, unfortunately, it will become part of the policy conversation. And no doubt, in time, it will get discussed at greater lengths. I guess, there seems to be a natural flaw as to how negative these types of interest rate policies could be. But I think that, as we go forward, we would absolutely expect that, on a medium-term basis, if we are to remove cash from circulation and go to a highly digitalized environment, as is probably fairly likely, then potentially negative interest rates can actually be quite a bit lower again. So, but I do think that's some ways away. I do think it will be part of that policy conversation in time, because sadly it's part of the policy conversation, as I said, and it's embedded in policy in places like Japan and Europe. And it's very much on the table and very live in places like the UK, Canada, and the RBNZ in New Zealand.
Charlie, I just want to go and pick up on a point you started off with by talking about the reactionary function of the RBA pretty much since the end of the GFC. A lot of that comes down to its forecasts that have been presented now. There's been a well-regarded trend that very glass half full, the RBA at the best of times. Does the bank need to go and reassess what it does when it comes to those forecasts? Because it has led to what you could probably perceive to be policy mistakes in the past.
Yeah, look, I think it does. I mean, clearly, the central bank needs to stand up and provide some confidence to the economy. They don't want to hit the podium and tell you how bad things are. They do want to always talk from that glass half full perspective. But at the same time, some of the commentaries that have been made over the journey, things like, the neutral rate of interest in the economy is 3%. That's the comment that I said is somewhat in a parallel universe than with regard to where we are in the global interest rate cycle. We then were held at 1.5% and told that we were very unlikely to go below. That was from mid-2016 to mid-2019. And there's no question that the way that we've got here has been extraordinary. I mean, COVID is the great accelerator. What it really has done is it's sped up all of these secular themes which were percolating through things slowly, and now of course we've gone into hyperspace with regard to how fast these things are occurring. So as I said earlier, I don't think the RBA have wanted to do any of this, but they've needed to, and they've needed to react. And so that question then becomes, should they be reactionary or should they try and be proactive to smooth that cycle and provide more assistance before the case? And so yeah, the forecasting has been off by a large amount. Look, it's been a difficult environment, no question, and through trade wars and the like of 2018 did provide some turbulence, but I think that there's no question that they could revise that and try and tighten that up a little bit.
So today, we saw a swift reaction in currency markets. What do you anticipate? Will there be any reaction in bond markets?
So longer dated bonds in Australia are rallying quite substantially today. They're up 6 or 7 basis points. And that's in expectation that the RBA will at some stage be supporting that part of the curve with their quantitative easing program and could be looking to purchase securities further out the curve. Obviously, that program has targeted the 3-year point on the curve up until this stage, and apart from the very early iterations of coming out of March and April, where it did support bonds up to a 9-year maturity. So I do think that Australian bonds are quite substantially cheaper than their global counterparts, and the RBA have acknowledged that today and said that they can support more, provide more sustenance for the economy by potentially supporting that part of the curve. And the markets will shoot first and ask questions later. So there's been some fairly heavy buying in that part of the term structure at this stage, and obviously the currency is a little lower. And I think that's an acknowledgement that the RBA are looking very, very live here for November, and clearly committed to doing more.
They're in the curve, so that's gone and taken the wind out of the high-flying Aussie dollar. Charlie Jamieson from Jamieson Coote Bonds, thank you so much for your time this morning. Great chat, and enjoy the rest of your day.
Thanks a lot.